So growth versus inflation, what exactly should Reserve Bank of India focus in on? Let's discuss that with the two fine gentlemen, Amitabh Monti, Head of Fine Income with Fixed Income with Reliance Capital, and Gaurav Kapoor represents RBI. Gentlemen, good morning. Thank you for joining us. Amitabh, if Reserve Bank of India today obliges with a 25 basis point rate cut, do you think that will not excite bond market? Because by and large, in the run-up to the credit policy, bond yields already have corrected.
Yeah, I guess that's about right. Bond markets are more or less priced in a 25 basis point cut. I think what's going to drive the markets is what RBI going to say in the statement rather than what they do. We'll be very surprised if they do more than 25 basis points or not at all. Even on the CRR front, I don't think we're going to see any action just yet. So I think what the market is watching is what RBI is going to state in the policy beyond the cuts.
Gaurav, I want to get you in on this. The central bank has pointed out yesterday in the macro report that growth has bottomed out, but recovery would be really slow. Do you think that RBI may choose to front-load interest rate cuts during the first half of FY13, or would the RBI choose to significantly cut interest rates towards the second half? What's your view?
I think whatever rate cuts, the magnitude, whatever magnitude one is expecting, or I think most of the cuts will happen in the first half of the year itself. Whatever 50 to 75, we are expecting about 75 basis points cut in the first half of the year itself. I think it will be paced over the first half. RBI will. The situation is very dynamic. I mean, they have to balance growth concerns on one end. They have to balance, along with that, they have to balance the fact that there are suppressed inflationary pressures. Inflation is likely to remain sticky. But that said, growth, as per their own, as per the macroeconomic report, they're expecting investment activity in particular to remain subdued in the first half of the financial year. So some impact of rate cuts, or favorable impact of rate cuts on investments, it has to be generated. So it has to be done at the beginning of the year than in the second half of the year. Actually, more aggressive cuts second half of the year looks more unlikely to me, because I think there is a time lag in monetary transmission as well. So RBI would want to start the ball rolling at the beginning of the year than to kind of delay it towards the second half or later in the year. So it from a purely transmission perspective, it makes more sense to get it started at the beginning of the year itself, considering the fact that for the last couple of policies, RBI has now very clearly and vocally spoken about their growth concerns.
And Gaurav, are you with the consensus view that today would be a 25 bips cut? And what about CRR? What's your expectation there?
Yeah, I'm with the consensus view. I'm expecting a 25 basis points cut today and no change in the CRR. I think liquidity conditions have improved. RBI has indicated in the policy in the report yesterday that conditions are likely to remain fairly stable during the first quarter of the fiscal, and the LAF volumes are now in the comfort zone of the RBI, and for the last couple of months they have not intervened significantly, so they have not really taken money out of the system, and I think there is a fairly significant amount of redemptions coming in April and May in terms of of government bonds. So all in all, I think, and with slow pickup in credit offtake, I think by and large liquidity situation should be okay, and I don't think RBI is looking to switch from deficit liquidity to surplus liquidity at this stage at least. So you will continue to operate in a monetary policy regime where they do cut rates, but they continue to operate in a deficit liquidity regime.
Amitabh, the fiscal situation is still has deteriorated in last 6 months. Global commodity prices are still high. What to your mind are the chances that today Reserve Bank of India may not actually announce some kind of policy action?
I think it's fairly low. I think the concerns that have been raised in the report yesterday were very valid. But I think given the amount of tightening that has happened and kind of collapse on the growth rates, I think at least from a symbolic perspective, a repo rate cut has to be delivered. Otherwise, I think the sentiment is going to take a turn hugely for the worse. So I think 25 basis point, I think, is almost a done deal. I'm sticking my neck out here a wee bit, but I think not doing anything is a hugely risky act, which I don't think RBI will do right now. I think they'll deliver consensus.
Amitabh, how do you think they're going to address the liquidity situation? Because one thing that the market is really concerned about is fiscal slippages. How do you think the central bank will approach and solve this issue really?
See, in fact, you've hit the ball on the nail on the head. I think more than the rate cuts, I think it's a liquidity situation which needs to be addressed. And today, I think RBI really needs to look very closely, given its inflation concerns. Even then, I think they need to send a very strong signal to the market that liquidity situation will be addressed very significantly, whether it's done through the CRR at some point of time or through secondary market purchases of bonds or OMOs. I think the market clearly needs a very strong signal on liquidity and comfort on liquidity, which will enable the short-term rates to actually come down. If you look at the curve, the short-term part of the curve is actually flat to inverted, which is sending a very strong and possibly a negative message to a lot of corporates and the banks. So I think the curve has to correct itself, and we are all waiting to see if the curve will steepen, and that I think will solve a lot more problems than actually explicit repo rate cuts. So we are looking for action on the liquidity front rather than on the rate cut front going forward.
Gaurav, what do you expect to hear from Reserve Bank of India today when it comes to their key estimates and assumptions for FY13 for inflation and then for GDP growth?
I think on GDP growth first, actually the RBI report yesterday did not present their own estimate. They actually presented an estimate of a survey they conduct of forecasters within the banking industry. So to that extent, I think it's wrong to assume that they said it's 7.2. But I think they will, their number would be between 7 to 7.5. In fact, in the last annual policy in April last year, they did present a fairly wide range under of GDP growth, where they actually had looked at 7.2% on the lower side. And as we see, the year is actually this fiscal year or the last fiscal year was lower than that. So I think it would be interesting to see what range does the RBI project more than a particular number. But I think by and large, I think they would be closer to what the finance ministry has projected. They would be closer to about 7.5 than not. On inflation, I think they'll continue to hold on to a number of about 6.5, a range between 6.5 to 7 for the end of March 2013. And it sounds a little aggressive, considering that over the next couple of months inflation can ease, or actually till about November you have fairly significant high base effect, which will kind of dampen the headline inflation. But one, inflation remains sticky. Two, there are suppressed inflationary pressures. And three, global crude oil prices, the incomplete pass-through, and the fact that they are holding on well above 120 has implications for inflation. So does a weaker rupee. So I think RBI is going to balance out in terms of their growth, and I think they're going to be presenting a more reasonable picture on growth and a more reasonable picture on inflation. And in fact, RBI throughout the previous fiscal was continuously reviewing, especially their inflation target. So it would be interesting to see what ranges they place than to really kind of say that this is the number I'm looking at. Because I think what really matters is that given the dynamic situation we live in, it'd be interesting to see what kind of possible downside the RBI is projecting on growth and a possible upside they're projecting on inflation.